And that basically means that they're going to debase the currency even more. And that means that gold and silver, measured in debasing currencies, will rise in price.
The world's economy is an absolute mess. And with inflation surging and unprecedented debt, gold and silver should be surging. Why has precious metals stayed the same levels?
Or falling.
Or falling.
Or falling, yes. I think, the easy answer to that is that the investment community's attention has moved from inflation to recession. So now suddenly nobody's thinking about what's happening to prices, or perhaps they're thinking that what will happen to prices is that they will normalize because we face a massive recession. So inflation to these guys is not such a problem. The real problem is recession. And so you can see that from that point of view, everybody's just getting out of everything which has got risk. And, if you're a Keynesian, that includes gold and silver. The only place where you don't have risk, apparently, is in US Treasuries. And so you can see that not only US Treasuries, but government bonds around the world, their yields have dropped in the last 2 to 3 weeks, fairly significantly. And I think that, if you like, is the short answer to it. There is another answer, and I think a more technical one, and that is that the bullion banks want to try and get their books straight. Now, on COMEX, they're long of silver. I don't know, and nobody knows what their position is in London. Bear in mind that these banks all run unallocated accounts for their customers. So they are effectively short to those customers unless they are fully covered with physical silver, which of course they're not. And the same is true of gold. In terms of gold, certainly in London, there is a huge short position on the derivatives. The risk to it is probably theoretically limited, because what bullion banks do is they will take out options, if you like, to limit the downside from their point of view of rising prices. But who are their counterparties? Their counterparties are other people in exactly the same problem. So you've got a derivatives-driven market. Obviously, these bullion banks want to get their positions down. And the only way they can do that is by playing on the fear, if you like, that we have a recession, inflation has gone, so sell your gold. And that's really what we're getting. And it works very well as far as they're concerned with the hedge funds, because the hedge funds just do a pairs trade. They buy gold, sell dollar, buy gold. And you can see that the gold's trade weighted has absolutely soared in recent weeks. So from a hedge fund's point of view, they will short gold and go long the dollar. And so that, I think, is really the sum total of the dynamics driving it at the moment. It is not anything to do with sensible, logical, thought out economics. It's purely technical in that sense.
Are we making a mistake to, a lot of people seem to think that we're, trying to make this comparison to 2008 and trying to find out what stage of 2008 are we in, the financial crisis. Are we, what's the trigger that's going to make gold go up 100% or something?
It's an interesting comparison, Jim, because I'm sure you will recall that the initial response of the market was to mark gold and silver down very sharply when Lehman failed. And we then recovered from, I think it was $680, something like that, and ran up to 1920, with really quite quickly. So it is interesting to me because really what that indicated was that the first reaction was essentially a Keynesian reaction, and it was not the correct reaction in terms of valuing, if you like, gold and silver in the sense of financial assets. So, and we saw this again because you will remember that in March 2020, the stock market collapsed. Bond yields, if you like, bonds became, if you like, the safe haven for people trying to get the hell out of equities. I mean, the equity market fell fully 1/3. I mean, we forget this now. And that forced the Fed to reduce the funds rate down to 0 and to bring in QE of 120 billion a month. Mm-hmm. And that turned the market round. And what had happened to gold and silver was it really caught the bullion banks on the hop. And you remember that the exchange for physical market blew up. And we saw ridiculous stories coming out of the LBMA and the CME about how, gold was just in the wrong place, but they were going to fly it over and it was going to be all right. And they sort of worked together to try and stop the market rising, which is effectively what it is. And to my mind, that is exactly what we've got now. We've got that situation developing yet again, because we can see that the bullion banks are driving the prices down. They're taking advantage of the current situation, the so-called strength of the dollar, which is not strength at all. I mean, off camera, we were talking about the dollar and how it is, the least weak of a bunch of weak fiat currencies. But make no mistake, the inflation problem is there. And it's going to continue because of all the money printing that's happened, particularly over the last 2 years, and more generally well before that. So, and we know that the response of the Fed will be to always make sure that there is sufficient money available for people to spend. And that basically means that they're going to debase the currency even more. And that means that gold and silver, measured in debasing currencies, will rise in price.